Hello and welcome back. We left off on this slide in part number one, and this was the journal entry to record the payroll in the governmental activities journal at the government-wide level. And remember, we record expenses in the governmental activities journal, not expenditures. So here was that entry, but we went over it previously, so let's move on. The employer's share of FICA is recorded in the general fund. This is a different share of FICA, not what was withheld, but the employer's share. So the expenditures are recorded at 88,000 and due to federal government at 88,000. And the expenditures ledger, they just divided it up between the three departments here. The employer's share of FICA is recorded in the government activities journal as seen below. Expenses, and then they list each department. And then due to federal government. So it looks a lot like the expenditure subsidiary ledger for the general fund, but we record it with that detail in the expense accounts for the government activities. Oops. Accounting for property tax revenue. The tax levy basically is the total amount that the government is taxing. It's the amount billed to taxpayers. And the initial determination of the required tax levy is the levy equals revenues required divided by estimated collectible portion. So if basically what they're doing is they're saying the estimated collectible portion might be 95%. So if you divide the total revenues required by that 95%, you get a larger number, and that's the total tax levy required to reach that revenues level that they're aiming for. So, as an example, the tax rate is the measure that is actually set by legislative action after the required size of the levy is determined. Tax rate per $100 or per $1,000 of assessed valuation equals required tax levy divided by assessed valuation, which we just talked about. If tax rate exceeds the statutory limit, it will be necessary to reduce the required tax levy and readjust the budget accordingly. So a lot of times there's a statutory limit for specific taxes, and the government can't exceed that without passing new law. So they would have to reevaluate their budget rather than actually raising the tax rate to that new level. So the assessed valuation is generally determined by an elected tax assessor. The calculation again is assessed valuation equals estimated true value of taxable property times assessment ratio. Generally, like this would be really easy to see in a property tax situation. So you might have, let's just say, $1 billion of property, and then you would times that by your assessment ratio, say 1%, and that's your assessed valuation. So 1% of the billion would be 10 million, and that's what you would get. In many jurisdictions, the assessment ratio is 1, such as the full estimated market value. In other jurisdictions, it might be some fraction of full value. Assume revenues of $495,000 are required, and it is estimated that 1% will be uncollectible. So the total levy would be the $495,000 divided by the 99%. So the levy would be $500,000. So let's book that. Taxes receivable current would be $500,000. Remember, that's the total levy, the total tax that the entity is charging. And then they already know, or they estimate that this $5,000, the 1% will be uncollectible. So they'll book that estimated uncollectible current taxes credit of $5,000, and then revenues credit of $495,000. The required entry at the government-wide level is similar, except for that the credit is to general revenues as follows. Taxes receivable current, so that's the same. Estimated uncollectible current taxes, general revenues. So we just basically add that general revenues here, 5,000, and then property taxes, 495,000 instead of revenues. So you can see a little bit different there, but pretty much the same thing. Assume by the end of the year, 450,000 of current taxes have been collected. The entry is cash, 450,000, and then we have to reduce that taxes receivable. So this is for general fund and governmental activities. This looks the same. The entry to reclassify uncollected current taxes to delinquent status at year end for both general fund and governmental activities is taxes receivable delinquent, 50,000, and then we'll actually have to reduce the other taxes receivable account, the current, by 50,000. Estimated uncollectible current taxes, 5,000, and estimated uncollectible delinquent taxes credit the 5,000. So you basically have to book those new asset accounts and reduce the old ones. Interest and penalties of $500 are accrued on delinquent taxes of which 10% is estimated to be uncollectible. So for the general fund, we would book a debit to interest and penalties receivable. We would credit estimated uncollectible interest and penalties because we said 10% is uncollectible, so that's 50. And then credit revenues, 450. So we expect to get 450 of these $500 worth of penalties. And remember, before I go on, we're recording these because they're measurable right now, and we reasonably expect to collect them within the near future. The required entry to accrue interest and penalties at the government-wide level is similar, except for the revenues account. So interest and penalties receivable on taxes, $500. Estimated uncollectible interest and penalties, credit for 50. And general revenues, interest and penalties on delinquent taxes, 450. So you can see that revenues is what really changed. So to write off uncollectible taxes, assume property taxes of $500 are written off on which accumulated interest and penalties amount to $80. The required journal entry is as follows. Estimated uncollectible delinquent taxes, we're going to debit for $500. Estimated uncollectible interest and penalties, we debit for $80. And then taxes receivable, we have to reduce $500. Remember, because we're replacing it with this estimated uncollectible account. And interest and penalties receivable on taxes, we're going to credit for $80 because we're replacing it with the estimated uncollectible interest and penalties account. Issuance of tax anticipation notes. Revenues from property taxes are often collected during 1 or 2 months of the year. Expenditures demands may occur more or less uniformly during the year. So this presents a problem, right? Because the cash flow is very lopsided, whereas the expenditures aren't so much. They're very much more spread out. So a local bank may extend a line of credit in the form of TANs, or tax anticipation notes, to meet short-term cash needs, since the notes will be backed by the power of lien over taxable properties. So this is basically a form of a secured note, because the government can over time, if you don't pay taxes on property, they can seize it from you. So they would, if you didn't pay taxes for a certain amount of time, they would place a lien on it, and you'd have a certain amount of time to clear up that, and then they would seize the property and most likely auction it off and recover their costs in that way. Assume on April 1st, 2014, Clark City signs a 60-day, $300,000 tax anticipation note, discounted at 6% per annum. So their cash is, we're going to debit for $297,000. Remember, it's 6%, but it's only a 60-day note. So we're debiting $297,000. Expenditures of $3,000 for the difference, that discount, and then the tax anticipation notes payable is $300,000. The entry at government-wide level would be the same, except the debit is to expenses, general government, instead of expenditures. Remember, expenditures for the funds, expenses for the government-wide level. Clark City repaid the 60-day $300,000 tax anticipation note on the due date. So we would reduce that payable, tax anticipation notes payable, by debiting $300,000, and reduce cash by crediting $300,000. Question: why might a government need to revise its legally adopted budget during the year? So we're going to go ahead and break this slide, this presentation here, because we're reaching the end, and you can think about that for a little bit before you start part 3 of chapter 4.